Hello, everybody. Thanks for joining us today on this lunch hour on the Eastern side and a little earlier in the morning on the West, or wherever we are joining in from. We have myself, Eric, Pear on the line, Jeff, so the whole team, Leah, Rebecca is also joining us. So we have a great presentation today talking about cross-border planning for Canadians. And Rebecca is an oracle on our TREP team, our tax, retirement, estate planning, and she's wonderful in all things accounting, cross-border, trusts. So she's a really great wealth of knowledge and a wonderful resource that our team has and that CI Sante has. So very excited to have her join us here today. So we'll just leave a minute or so for everybody to join in. We'll say hello to our attendees. Hello, Leanne. Hello, Marty. Hello, Nat. Thanks for joining us, Ose. Hi, Sarah. Hi, Will. And hello, Yoga. So we've got a nice group joining us today. Great attendance. So we are excited to get started very shortly.
And thanks to everybody that's listening to this recording as well. It will be available on our YouTube channel. Maybe you found us there. So hi, Paula. Thanks for joining.
Perfect. So we're going to get started in just a second. As we do that, I'll give an intro about what we're going to talk about today. So Rebecca's going to hit on three topics as it relates to Canadians and U.S. tax implications. For one, we're going to look at the definition of U.S. persons for tax purposes. Rebecca's going to take us through that. We're going to look at IRAs. I mean, for many individuals that have worked in the U.S. that might have accumulated some assets, we're going to look at what the options are in the sense for bringing those back to Canada, leaving them there. So Rebecca's going to talk us through some important considerations there. And then we're also going to have a look at the U.S. transfer tax system and what some of the implications are there. So we've got a stacked agenda. Again, we're going to record this. So if you missed anything, we're going to send that out after the fact. And if you do have any follow-up questions, you'll be able to send those through. We like this to be an interactive webinar, so please use the chat or the Q&A below. We'll be monitoring that throughout, and we'll be keeping the questions flowing. And if Rebecca can answer them, perfect. And if we have to take them offline, then more than happy to. But we encourage you to send any questions as it pertains to the presentation, and we'll do our best to answer them and address them. Perfect. So we have the whole team here. We have the three figureheads, myself, Pear, and Jeff. So very excited to share what Rebecca has for us today. And Leah and Ose, who help keep the practice running and who do all the wonderful work behind the scenes and at the front of the scenes. So very happy to be presenting our team in conjunction with Rebecca today. And lastly, we've got Rebecca, who, as mentioned, is from our CI tax, retirement, and estate planning team, our oracles of knowledge, as we like to call them. They have a really great breadth of knowledge for cross-border tax planning, trusts. It's a really wonderful team that we have at our disposal to connect with. And we're very happy to have Rebecca calling in from Calgary today. Fun fact about Rebecca, she's an avid skier. And her and her family all ski at Lake Louise. So it comes from our practice that we are all avid winter sports aficionados as well. So happy to share that, Rebecca. And without further ado, we'll pass it to you just to say hello, and you can take it away from here.
Thank you very much, Eric, and thank you everyone for inviting me today to speak, and to all of you listening. I hope that our time together will be educational, and it is my understanding we can make the slides available as a resource after the fact. And generally, any sort of quick question, as indicated, do try to put it through during our time together this morning. Anything more, deeply fact-based is generally something that's best a takeaway from myself or a member of my team to look over and provide a response in a timely manner thereafter. So with that, I will share my screen. It says I cannot, other participants sharing, I just have to do a quick adjustment. Thank you very much. That's great. So cross-border matters for Canadians. So this presentation actually covers off certain elements that are relevant for Canadians with U.S. situs assets, which includes U.S. property, but also for U.S. persons living in Canada. So there's a little bit of back and forth in respect of that, and I'll try to make sure it's clear where this is relevant when that matters as we move through the presentation. So the agenda, as Eric said, and sort of refining it a little bit, we will talk about that U.S. person for tax, take a look at the other side of that. What is a non-resident alien? Some compliance matters also related to Canadians who own U.S. real estate. And then we'll take a look at transferring those retirement plans up into Canada, a few other issues, and then close off with a look at the U.S. transfer tax system. So the definition of U.S. persons and non-resident aliens, which would be the converse definition. So the idea is, I think we all need to know, every human being on the globe needs to have an understanding of whether or not you are a U.S. person for tax purposes, because the United States is one of only 2 nations in the world that tax based on citizenship. There is I think the East African nation of Eritrea that is also a citizen-based taxation regime, but the US, of course, being a global economic power, it has considerable relevance, their citizen-based taxation, and it's something we all need to know about. So you would be considered a US person for tax purposes if any of these elements apply. So if you are born in the United States, even if you lived there a day of your life, you are a US person for tax purposes. Also, if you are born outside of the US, but both of your parents are US citizens, you are a US person for tax purposes, full stop. And then you can also be a US person for tax purposes if only one of your parents is a US citizen. So in that case, then you have to look down a little bit further to your own birth date. So you were born on or after November 14th, 1986. If that is the case, and then your US parent lived in the US for at least 5 years, and then 2 of those 5 was after their 14th birthday, then you would be considered a US citizen for tax purposes, a US person for tax purposes. And this would be, who would we know that falls into this example? I think very commonly Meghan Markle. And then I believe if he's taking the title of Prince, now Prince Archie would be a US citizen by virtue of his mother's citizenship in the United States. And then if you were born before November 14th, 1986, then your US parent was living in the US for at least 10 years. So they had to live in the US longer, 5 of those after their 14th birthday. So you have to dig deeper when we're thinking of our own circumstances, the circumstances of the people that we know, or as advisors supporting clients, we need to be asking these types of questions and understanding who all can get caught in US personhood for tax purposes. So that's sort of by birthright, or you inherit from certain family members. Also, if you're a green card holder, you would be considered a US person for tax purposes. Immigration and tax are separate things. I am not an immigration expert by any means, and certainly not an immigration lawyer. Surrendering your green card for immigration purposes is not the same as for tax purposes. So if you are a green card holder, or you were a green card holder and you think you don't have it anymore, you need to be working with or consulting with a dedicated US tax, I'm gonna suggest lawyer, who understands well this aspect of the system to be able to confirm for sure if you are considered a US person for tax in respect of that green card. And then lastly, you would meet the substantial presence test. So you're not a citizen, your parents weren't born in the US, you don't have a green card, but you like to be in the US for a considerable amount of time. If you are considered substantially present, then you would be considered a US resident for tax, just as if, and essentially reporting your world income to the IRS the same as if you were a US citizen or a permanent resident. So what does meeting the substantial presence test mean? Generally, you've spent 183 days in the United States in a particular year, or if you've spent at least 31 days in the current year. So in the example of 2022, say I spent at least 31 days in the United States in 2022, then I have to look back to the prior 2 years. And if that formula that you see on the bottom of the screen equals 183 days or more, then on the face, I would be considered substantially present in the United States. Generally speaking, then on an ongoing basis, spending about 4 months in the United States a year would trigger that that result that you would be considered substantially present in the United States. So some things to be thinking about.
Rebecca, I just wanted to ask you about the calculation that you're giving, which is relevant, I think, to many of our clients. There's a trick about when you return. If you return to Canada for, I don't know whether it's less than 24 hours or whatever, they don't consider that a day away from the US. There's some fussiness about, when you come back to Canada, how long you have to be here or how long you have to be out of the US before they stop counting.
That's exactly it. So a part day, if you're in the US for a part of a day, that does count as a full day. This slide actually, thank you for the segue. It talks about that there's some exception if you have a connecting flight, for example, or if you're a commuter in the US, so you live on the border, you're commuting in and out for work, there would be exceptions there. But if you are only returning to Canada for part of a day, that would not be excluded from your day count. For example, there were some other exceptions during COVID for medical matters, and there still can be, but that sort of at a high level, those would be the things to be mindful of. A part day counts as a full day. It is not to say that, oh my goodness, I've got my 183 days, and we hear stories, well, how do the snowbirds, they can be in the United States for more than that. Then there's a couple of elements. Either you can establish closer connection to Canada, so that involves filing of a particular form, and effectively you're arguing that your ties are closer to Canada. So you can fall under that closer connection exception only if you spent less than 183 days in the US in the current year. If that's not the case, so you've spent more than 183 days in the current year, then it's still possible to what we call tie break back to Canada under the treaty. That involves the filing of a different form, and effectively you're taking the position that your center of vital interests, your social and economic ties are to Canada. There's a lot of overlap in those tests, but just have an understanding that, yeah, substantially present, okay, I can be considered a US person. I don't want to be a US person. I'm a Canadian. I want to be tied to Canada. Then there are a couple of different ways that you can potentially do that, depending on how many days you spent in the United States in the current year. And I would absolutely suggest, these are not do-it-yourself forms. No IRS form is. I would absolutely suggest you want to have a US accountant and potentially a tax lawyer on your side when you are taking these filing positions. So did that answer the question, or?
For me, it did, yes.
Excellent. Okay, so that's sort of the definition. So US person for tax purposes is very, very, very important. Again, because of that citizen-based taxation. And then if you're not considered a US person for tax purposes, you would be considered a non-resident alien in respect of the US. Quick example, just myself. I'm born in Canada. My parents were born in Canada. My grandparents were born in Scandinavia. I'm not substantially present in the US, and I don't have a green card. I would be considered a non-resident alien in respect of the US. So moving to tax compliance, why is this all important? Why do we care so much? Because citizen-based taxation has been in place in the US for years and years and years and years and years. But we're having conversations more and more about it because of FATCA, Foreign Account Tax Compliance Act, signed by President Obama into law in 2018. And what does FATCA do? In short form, it is a snitching service, so to speak. It allows the United States to locate US persons around the world who don't live in the US, and essentially to assess US tax and or penalties in respect of those folks. Because again, remember, the US does not care where you live. If you are a US person for tax, you are taxable on your world income and your world estate, just as if you lived in the heart of the United States. So FATCA comes into law in 10. Enforcement begins in 2014. So effectively what FATCA does is it requires all foreign governments and financial institutions of the world to identify and disclose their US person clients to the IRS. That includes, joint ownership, US signatories. It's a very, very broad brush. So the foreign account holders need to certify their status via the W-8 BEN form. So that's a form that we hear a lot of. And then there's also reporting under FATCA. So if your asset thresholds meet a certain, if your asset levels, meet a certain threshold, then you're filing the 8938, which is the form that is required to be filed under FATCA. And in addition to that, we have reporting under Fbar. So I think it's FinCEN form 114. That's not an IRS form, but I think many of us are much more familiar even with Fbar reporting, where you hold what the US would call a foreign account. So I'm a US person, I live in Canada, I have a Canadian bank account that has $10,000 or more in it. I have to report that on my Fbar reporting annually. So enforcement began in 2014, and now as of January 1st, 2020, any foreign financial institution, so any Canadian financial institution who does not properly report these folks to the IRS will can incur penalties. That it can be financial penalties, but it also include the prevention from doing business with the United States, which is something that no major entity would want to have to deal with. Current administration allocating more resources. So in the recent legislation passed, and now the name is escaping me, the Inflation Act that was passed by President Biden in August. As I recall, it allowed for another 87,000 agents to be, and they are tasked with enforcement collection. They are looking for people who don't live in the US, who have US ties, and the ability to tax these folks. And we talk about coming out of the pandemic, government debt. We now talk about, major climate disasters, including Hurricane Ian, and the amount of money that governments need to be able to help their populations through these issues. Certainly they're looking for tax revenues, and certainly it's politically much more palatable to be able to find this money through people that don't necessarily live on shore. And that doesn't mean you don't have a vote, but it certainly does mean that that vote counts differently, or whether or not that vote counts depends on certain elements as a result of the election process in the United States. So compliance and enforcement. And then just quickly, so if I'm a US person and I live in Canada, what are my filing requirements? This is very simplistic, but on the face, you're filing the 1040 annually. That's the equivalent of the Canadian T1. It is very, very likely that you would not have a tax liability associated with that. It's like to the US, very, very likely for a few reasons that are listed on this slide, but you have that filing requirement in any case. And generally speaking, to claim treaty relief, you need to be filing your forms. You also have FATCA, so I had alluded to that earlier, and the asset thresholds are shown on the slide. In addition to FATCA, of course, we have Fbar reporting, tons of overlap, but if you have to, filing one doesn't exclude you from filing the other, and then a host of other compliance forms, and a few of them are listed here. The issue with compliance in the United States is failure to file penalties. In Canada, we're more accustomed to failure to file penalties with respect to the CRA, sort of looking at $25 a day, $2,500 maximums. It varies, but we're talking sort of in the hundreds of dollars generally. In respect of IRS failure to file, at first instance, you could be dealing with $10,000 US penalty, per form per year. So it's extremely punitive. So we want to make sure that as a population, we understand whether or not we have a filing requirement to the US, and then making sure that where we do, we understand what are our deadlines and what are the penalties for failure to file. Pardon me, I'm just going to move this along quickly.
Rebecca, while you're moving us along, and I'm sure this has come up, the $10,000 penalty is definitely increased the fear factor for many non-resident U.S. cited citizens. Have in your experience, have you heard of any of these fines being levied, or in a major way, or on small balances or smaller clients, or is it still in its infancy stage as far as penalties are concerned?
I'm going to suggest it's more in infancy because we're, FATCA, and this is all born out of FATCA, because FATCA is what creates the ability to be discovered, so to speak. So I'm going to suggest this is still in an infancy stage, but certainly the trend continues to more ability to enforce compliance. I would not for a moment want to be a US person and not be compliant. And when you look at the trend towards renunciation, I think that speaks to what people are experiencing, pardon me, in terms of assessment by the IRS. That's as far as I can take the comment.
I do know there's a lot of instances where, people don't even have or know of their social insurance number, realize they haven't realized they may be offside. It's been years. And then there is a process whereby they can make a declaration and file the back years to get back on side without incurring penalties, correct?
That's right. But effectively, in order to fall under sort of these amnesty programs, you have to go to the IRS before they come to you, generally speaking. And so I think that's where we can really support, again, people we know ourselves or our clients, is to educate them about what their responsibilities are. And then they can make that decision to go forward and say, okay, I'm not compliant. I need to get compliant. How can I do that? There are, as I say, there are several programs available. One of the ones that I can speak to just generally is if you do want to renounce. And again, this is not about renunciation, and I'm not suggesting that whatsoever, but for those people that do want to renounce, there's a program right now, back filing 5 years, income tax, Fbar reporting. If there is a tax liability, there's forgiveness of up to $25,000 US in tax, and then full forgiveness of any penalties. So certainly if you're interested in renouncing, that program is there, but there are also programs for those that don't want to renounce. Again, the guiding pieces: go to the IRS before they come to you.
Good advice. Good advice.
Yeah, just with respect. So this is guilty. I just think it's important to highlight it. This piece of legislation came out of the Tax Cuts and Jobs Act. I should say this aspect of legislation was part of the Tax Cuts and Jobs Act that President Trump brought in 2017. And so effectively what it says, if I'm a US person and I'm living outside of the United States, now the United States can tax me on my undistributed corporate earnings. So say I'm a dentist, I have a professional corporation, I'm a US citizen, but I've lived in Canada all my life. My practice is incorporated. For Canadian tax purposes, yes, my corporation is going to file a tax return annually, but I personally am not taxed on the earnings of the corporation until the corporation pays a taxable dividend to me. So you're only taxed in Canada on distributed net earnings of the corporation. What the US is doing now is saying, no, we are going to tax, in certain circumstances, we are going to be able to tax you, US person living in Canada. We're going to tax you for US purposes on your undistributed corporate net earnings. Problem with guilty then is, so you have this this new layer of tax in the United States, and you can't offset using the foreign tax credit mechanism, because you can only use foreign tax credits to mitigate double tax where the income is being taxed in the same tax year. So if Canada isn't taxing you because you don't have a dividend in your hands personally, but the US is essentially looking through the corporation and taxing on the undistributed net earnings of the corporation, that's where you can have a double tax issue. There are off-ramps, if you will, but the point of sharing this today is just to create awareness that if I am a US citizen and I'm living in Canada or outside of the US, and I'm incorporated outside of the US, I want to be talking to my accountant about the application of guilty, and if I need to undertake any planning to mitigate my exposure to that tax. So I just want to leave that for further, just to be thinking about that.
I mean, bottom line, the US is looking for any potential US citizens who are accumulating wealth outside their country and not declaring it. I mean, that's really what their goal is. And a corporation is another way of perhaps accumulating wealth and not having to declare within the previous rules. And they're making that change to try to capture these things. But it's
absolutely. Yeah, I absolutely agree with you. These look-throughs, this ability to repatriate earnings, you know, make America better. It's sort of under that idea, and ultimately, you know, it becomes very complicated for those that have US ties. So if I'm a non-resident alien, so I had said that I was, you know, Canadian through and through, no US ties, but how could I possibly, from an income tax perspective, and that's really what we've been talking about so far, is income tax. How can I be taxed in the US? So effectively connected income. So if I might be living in Canada, but I'm employed in the US, or I'm conducting business in the US, that's pretty intuitive. Of course, you can expect to be taxed on that income. And you'd be taxed on a net basis at the graduated rates applicable to US persons, similar to what we know in Canada. Also, with respect to my investment income, my pension income, that fixed, determinable, annual, or periodic income, then I'm taxed as well. And generally here, you're dealing with withholding tax. So flat tax, 30% unless lowered by treaty. Generally, you know, treaty rates are less, 15% for dividends if you're a resident of Canada. Pension income's at 15. Most portfolio interest is at nil. No deductions here, but if that's all that I have, is this sort of pension or investment income, it's source withholding. I'm not required to file a tax return. The source withholding is sufficient, and I can move on. But I certainly do have to file a 1040 NR if I have that effectively connected income in general. And also I'm going to be filing a 1040 NR if I am reporting net rental income in the United States, or I have sold a US property that I own personally. So even if it's that vacation property, personal use, you're going to be filing a tax return for the year of sale. So non-resident alien, but I decide that I want to go and purchase a property in, you know, Arizona, potentially not looking to purchase in Florida at this point in time, but I think Arizona is still a good spot. I just have to be mindful that, you know, as long as it's purely personal use, there's not an income tax obligation or filing obligation to the United States. But once I start to rent it, that is US source income, and the US gets to tax that first. Now, I can be taxed in a couple of different ways. You can either choose the sort of gross rent received approach, which effectively you're remitting to the IRS 30% withholding tax on gross rent received. That 30% withholding does not have any treaty relief. So there's no clause in the treaty between Canada and the United States that reduces that withholding rate. The other option is I can choose to elect what we call the net rental income method. So effectively, you'd be reporting your net rental income on your 1040 NR, very similar to how you'd be reporting it on the Canadian T1. Again, taxable on both sides of the border, but you would have that foreign tax credit mechanism to mitigate exposure to double tax. So effectively, you'll end up paying the rate of the, you know, if you're taxed still higher in Canada than you are in the US, then effectively you'd be paying the Canadian rate, but you have to be filing and reporting in both countries. And if you do that net rental method, then withholding is not required. But once you elect to do that once, you're in it for life, essentially. You're reporting net rental and that filing requirement on an annual basis, so long as you have rental income from your US property. Ferpta is also something else that you want to be thinking about. So now this is the space where I am not a US person. I'm a Canadian, but I own this US real estate. So I go to sell it. So then we have the Foreign Investment in Real Property Tax Act, US legislation that comes into play, which effectively says that the purchaser has to withhold from the proceeds of sale and remit to the IRS via the form that's shown on the slide within 20 days of sale. So the purchaser must withhold from the proceeds, remit to the IRS. What are the rates? It depends on the selling price. So 15% if gross proceeds exceed $1 million, then it goes down to 10 if the purchase price was between 300 and $1 million. There's no withholding required if this purchase price was under $300,000. You can undertake as a seller to obtain a Ferpta waiver. That is another, and it effectively would be done through the filing of the form 8288. And there's a couple of aspects of that. Seller's compliance history is critical. So if you were renting your property and you weren't properly filing your 1040 NRs, then you're not going to be able to obtain this waiver. Regardless of Ferpta, the rate of withholding, whether it applies or not, whether you got the waiver, you have to file a 1040 NR for the sale of the residence. Any withholding tax that applies under Ferpta, sits as a, I've already paid that amount. You may get a refund at the end of the day when you go to sell the property, because Ferpta is based on value, but you're still going to be taxed based on capital gain in the United States. Just quickly, we'll mention, we all love our principal residence exemption in Canada. There's nothing stopping us in Canada from claiming a foreign property as our principal residence. So it can be fully tax exempt in Canada, but we still have this idea that it would not necessarily be tax exempt in another jurisdiction. Renting a property incidentally doesn't take away the opportunity to claim the PRE in Canada, but we want to be thinking about if it's taxable in another jurisdiction, it's not taxable in Canada, then I'm just fully taxed in that other jurisdiction. I have no ability to claim a foreign tax credit because I'm not going to be taxed in Canada on this capital gain. So if you have a different property that you want to, that would also qualify as your principal residence exemption, it can make sense to save the PRE for that, property that may be inside of Canada versus outside of Canadian borders. So just something to be thinking about. Generally, I'm going to hold this last comment because we've been talking about income tax. I'll speak to estate tax in the transfer tax section. So I'm just going to move along. And as I just said that, I apologize. I should have moved this slide. From an income tax perspective, again, we've got the filing of the 1040 on an annual basis. Certain income is reportable to the US, whether we're a US person or we're not. But we also have estate tax exposure, and I'm going to deal with that more in the transfer tax section. But from an estate tax perspective, if I am a non-resident alien, so I'm just, again, no US ties other than I've got this US property, from a planning perspective to mitigate exposure to estate tax, I'm going to suggest that trust planning is probably still your best bet. So generally speaking, use of a Canadian trust, purchase the property through that trust, and it can be set up by a Canadian trust company. There's certain clauses in it that need to protect from the US estate tax, but joint with right of survivorship can be problematic. You can certainly expose yourself to double taxation on the estate tax side, and also corporations, whether it's a US corporation or a Canadian corporation, that can be problematic from an estate tax perspective when we're dealing with real estate, if we're living in it, because you end up crossing the shareholder benefit rules in Canada, and that can be problematic. So just to leave you with probably just direct ownership as an individual, or potentially use of trusts would make sense. A Canadian trust would make sense if you're a non-resident alien looking to protect from estate tax and you're looking to purchase real estate in the United States that you intend for personal use.
Okay, okay, you're going to put the levels that they're looking at as far as net worth before estate tax becomes an issue on US property, correct?
Yeah, we're going to talk about that at the end, and I do apologize. I would have liked to have seen this slide in a different section. It was sitting up here, and I'll have to adjust that in the deck later. But we'll talk about that. So before we talk about transfer tax, which includes estate tax, let's talk about retirement and savings plans and the transfer of that. And the reason I include this in this presentation is because our team gets a lot of questions about whether or not you can transfer your retirement plan across the border. Right now, I will say that there are ways that you can transfer your US-based retirement plan up to Canada. The converse is not the case. You cannot transfer your RSP or your RRIF down to the United States, and you can't transfer your TFSA down to the United States. You also can't transfer the US cousin back up into Canada. So really nothing can go south from Canada into the US on a tax deferred or tax neutral basis, but there are options to bring certain types of plans up to Canada on what we say is a tax neutral basis. So definition of US-based retirement and savings plans. We have the 401k that I think that we're most familiar with. Generally speaking, this is akin to the Canadian defined contribution pension plan. So it's tied to some employment arrangement. There are also cousins of this. The 403b comes to mind, and there's a few other. Effectively, they're named after the part of the tax code in the of the Internal Revenue Service. But 403b, as I recall, is more public service, and then there's one more for folks that come from, academia, that type of thing. But the 401k, when we speak about that, it includes a lot of those types of plans, and effectively akin to the Canadian defined contribution pension plan. We also have the IRA, the individual retirement account. The Canadian cousin would be the Rrsp. We also have the Roth IRA, and the Canadian cousin to that would be the TFSA. Roth IRA, TFSA transfers not possible in either direction. So the only US-based retirement plan transfers that are possible, that are blessed by the Income Tax Act in Canada, would be IRAs and 401ks. So when we get questions about, does it make sense to transfer my plan up to Canada? The first question that I ask is, are we dealing with a US person or not? If you are dealing with a US person, there really is no income tax benefit and there is no estate tax benefit to moving the plan. It would make sense from those perspectives to just leave it in the United States, leave it intact. Why do people do it? Sometimes, and this is a little bit outside of my scope, but there can be trade restrictions. If you are a non-resident of the United States, then that the plan provider might decide that there's trade restrictions there. And so from an ease of administration perspective, it can still make sense to move the plan, or ultimately, you just want everything sort of in one country. But if you are a US person, you've got these plans, there is no income tax or estate tax benefit to transferring the plan. So really, whether or not plan transfer has any tax benefit depends. It's really limited to the situation where you're dealing with a non-resident alien in respect of the United States. The treaty itself, so the Canada-US treaty, allows RSPs, RRIFs, IRAs, 401ks to remain tax deferred until value is withdrawn from the plan, regardless of where the person lives and regardless of whether or not the person is a US person for tax. So the treaty blesses all of that. It's fine. You can move back and forth, no issues. You only start getting taxed when you start to withdraw from the plans. It's also important to remember, to be thinking about, so then you say, okay, you're a US person, or you're not a US person. Okay, great. How old are you? If you are under the age of 59 and a half, then there will be early withdrawal penalties that will apply if you try to move amounts from your US-based plan. And that's 10% of value effectively. So you want to initiate these transfers. If you want to avoid that early withdrawal penalty, you want to initiate these transfers when you are over the age of 59 and a half. And I'll talk a little bit more about the takeaways as we go through the next slide. So say you say, okay, no, you know what? I was down in the US. I did some work a few years ago. I have a 401k. I have an IRA. I've now moved back to Canada. I want to consolidate my wealth into Canada. I understand that there's some hoops to jump through, if you will, in terms of transferring the plan, but it's a conversation that I want to continue to have. How do I do this? What does this mean to me? So the treaty gives the US the first right to tax payment from the US based plans. So Canadian resident beneficiaries are subject to withholding tax on the gross distribution. That's intuitive. That makes sense to us. What are the rates? Any lump sum transfer from a US based plan is the withholding rate that applies is 30%. That's under domestic US tax law. The treaty allows for pension payments, periodic pension payments, to enjoy a reduced withholding rate of 15%. And again, the filing of the W8 or the W9 potentially would be required to get this withholding. But lump sum transfers are 30%. You can't access reduced treaty rates on lump sum transfers. Periodic pension, not defined under US tax law, but effectively, you can think, well, plan administrators will accept the reduced treaty rate if distribution or payments from the plan is occurring in installments that are, at least more than 1 year in length. If I am going to undertake a lump sum withdrawal from my 401k or my IRA, and I want to transfer it on a tax neutral basis into my RRSP, the only way that I can do that without impacting my RRSP room is to undertake this lump sum transfer. That's the only way. If I say, oh my goodness, I don't want to deal with 30% withholding, I'm just going to slowly withdraw from my US-based plan and drip it into my RRSP over time. I'll get 15% withholding, but then I need contribution room. So that's sort of the guiding principle in terms of what withholding rate will apply and whether or not you need contribution room in your RRSP to allow for the opportunity to move value from your US plan into your RRSP. And spousal plans would not be allowed here. You're moving from individual plan in the US, individual plan to Canada. So transferring my 401k or my IRA into my RRSP.
Sorry, Rebecca,
So
quick question.
Yes, go ahead.
On the previous slide. So let's say I take out my lump sum, or actually it shows it here too. So if I take my lump sum out and I have to pay $30,000 in withholding tax, when I claim that on my Canadian tax return, then I can claim that withholding tax that I paid that, right? And so that offsets my Canadian tax liability.
That's exactly it. Now, the special sort of, you'll see the reference to 60J of the Income Tax Act. That's a bit technical, no need there, but this is where this is coming from. Effectively, what the special rules allow is that, okay, I'm going to stop. So say I want to withdraw $100,000 from my plan. I'm accepting that the withholding rate in the US is $30,000. This transaction is taxable on both sides of the border. So in the steps, and I think this should answer a lot of the questions related to this and whether or not it makes sense. So $100,000 of plan value, we're going to ignore exchange rates. I've got $30,000 now sitting south of the border as withholding tax. So right now I have $70,000 to contribute to my RRSP. At this point in time, Canadian income inclusion is 100. Offsetting RRSP deduction is $70,000. I don't need RRSP room because I'm doing this in a lump sum. What do I need to do now to make this tax neutral? I need, in the year of transfer, to find another $30,000 from other sources to be able to have a top-up contribution. But again, contribution room is not required. But I still need this cash in hand somewhere to be able to facilitate this top up. So now it's a wash from a Canadian perspective. I've got $100,000 income inclusion. I've got $100,000 deduction. It's like, well, how is it tax neutral? Because I still got $30,000 sitting in the US, tax withheld. You need to do this in a year where you have sufficient income, Canadian source income, to be able to utilize the withholding tax in the United States. So my income in Canada has to be high enough that I can offset my Canadian tax liability with that $30,000 withholding in the United States. I can't carry forward the foreign tax credit. And for the year of transfer, I can utilize that foreign tax credit against all sources of income that I report on my Canadian tax return. So that's how it becomes tax neutral. But again, to make this really effective, you have to have that other source of capital to be able to do that top-up contribution. You have to have sufficient Canadian source income. And you have to understand that there might be, the CRA might not accept the foreign tax credit until you have proof that the 1040 NR is filed and accepted by the IRS. So it can take some time before the filing position that you submit initially is blessed by the federal government. So you can, if you're going to undertake this type of planning, you have to anticipate that potentially you could be out some cash for 1 or 2 tax years, depending how long it takes to get everything assessed and blessed by the tax authorities on either side of the border. If I'm doing this and I'm under the age of 59 and a half years, that 10% penalty, so another $10,000 in our example, it is creditable from a foreign tax credit perspective. So withholding would be 40 if you're under 59 and a half in this example, and the offsetting foreign tax credit on the Canadian side would be $40,000. So that kind of speaks to the, I'm going to suggest narrow circumstances where it can make sense to transfer your US-based plan up into Canada. Are there any questions before we move along? My comments generally are you sure that this makes sense? There is no immediate tax issue here. And then you speak about the other issues. And if the client still wants to go forward, then they just have to be aware that this is how it sets up from a practical perspective. So US persons, just looking at some other commonly encountered issues. So the blessing of tax deferral for our Canadian savings plans and the US savings plans is under the tax treaty, but as of 2014, that relief is automatic. We don't have to file a form anymore. And honestly, I can't remember the name of the form. You used to have to file one. You don't have to anymore. Similarly with RESPs, we get a lot of questions about RESPs. If I'm a US person and I'm a subscriber, that's not good. The US doesn't like that. They're going to tax the plan in the US as if it was a non-registered savings account. The US may also view it as a foreign trust. The issue is now you're filing a form 3520 and it's those failure to file penalties that you're dealing with. Recently, the US did away with this filing requirement, provided the RESP is otherwise compliant from a Canadian perspective. So that's a good thing. The planning tip here is if you have, for example, a family where you have one spouse is US citizen, one spouse is not, have the non-citizen spouse be the subscriber. You can also have US person beneficiaries. The real issue here is the subscriber. You can be a US person beneficiary. You can be, you can use RSP proceeds to study in a school abroad, all of that type of thing. There can be some additional filing requirement. The takeaway here is RESPs, as long as they're compliant in Canada, we don't necessarily have the other forms to file, but if I'm a US person and I'm a subscriber or a contributor to the plan, the US will tax it. US does not like TFSAs. I can be a US citizen, I can live in Canada, and I can be tax exempt on my TFSA for my entire life from a Canadian tax perspective, no problem, but the US will tax the plan on a current basis. So on an annual basis, they'll tax the income. They also want that 3520 filed with respect to the TFSA. So just some things to be thinking about with respect to being a US person and having these Canadian registered plans. Pfix also, anybody who's in the world of investment is familiar with passive foreign investment corporations. The US effectively, now you can think if I'm that dentist and I live in Toronto and I'm incorporated, maybe I have a holding company now. Maybe I've monetized or I'm retired. I no longer have an operating company, but I've got a holding company that holds the proceeds of sale of my corporation, and it's full of passive investments. That's a PFIC from a US perspective. What else is a PFIC? Looking at the bottom of this slide, Canadian mutual fund trusts or corporations. So it doesn't matter how the fund or the ETF is structured. If it's Canadian or it's non-US, and currency is irrelevant here. We're talking about, if it's on a US exchange, then it would be a US fund. If it's on a Canadian exchange, it's a Canadian fund. Potentially, well, segregated funds, I'm going to take the position that are considered Pfix, as well as real estate investment trusts that do not carry on active business. What are the issues with Pfix? Well, the US doesn't like that. They want you to hold their own, funds, ETFs, that type of thing. There's a lot on this slide. The point that I want to bring to bear is that if I'm a US person, I'm living in Canada, I want to invest in a Canadian mutual fund or ETF. That means annually I have to file IRS form 8621 I have to file that form for every holding that I have that would be considered a Pfix. On the face, the income of that fund is going to be taxed very punitively by the United States. I can make a couple of elections using the form 8621. And the most tax-friendly election is the qualified electing fund election, where effectively you end up just reporting your pro rata share of Pfix earnings and profits for the year as ordinary income or capital gain, depending on the underlying earnings. So making the QEF election allows the holder to have the most normal experience from a US tax perspective. You need the annual information statements from your financial institution in order to make this QEF election, which you make on the 8621. I don't know of a Canadian financial institution that does not issue these statements. Certainly CI does. To my knowledge, everybody does, and certainly can on request, but you can't just go and submit your Canadian T3 or T5 slips to your accountant and say, oh, here you go, here's what you need to make the QEF election on my 8621. You do need this additional information. So Pfix, possible, you can hold them, but they are taxed more punitively, and there is a filing requirement. So for our US persons who own Pfix, this is the regime that they need to be thinking about in terms of their tax compliance to the US on an annual basis. Are RSPs and Rrsps exempt? You can hold Pfix inside of those plans and have comfort that you're not going to get caught with any punitive tax consequences in the United States, but you can't hold them in your TFSA or your RSP or even an RDSP. So in closing, it's a few minutes here, and we'll talk now about the US transfer tax system. So US transfer tax system, of course, a US person living in Canada is going to be caught. If I am a Canadian who does not otherwise have US ties, though, how can I be caught in this particular tax net? So if I own US situs property. So that is real and tangible property in the United States. It's also US stocks and mutual funds. That includes money market funds, that type of thing, certain debt obligations, and certain business assets. So now we're no longer talking about income tax. We're not talking about Ferpta on the sale of our US real estate. We're talking about I am owning US situs property, and I might have to pay either estate tax on my death in respect of that, or I might be subject to gift tax should I gift that property during life. Now, here you go. Say I go down and I decide I want to purchase a property in Arizona, and it's going to be a vacation property for my family. If I add a spouse or a child as a joint owner to that property, I'm going to trigger gift tax from a US perspective. There's also Canadian tax issues with that, but we're not talking about that today. I'm going to trigger gift tax from a US perspective. It's important that I understand, as a Canadian or a non-US person, if I own $60,000 US or less on the day that I die of US situs property, I do not have a US estate tax liability, and I do not have a filing requirement to the United States. But if I own 60,000 US or more on my date of death, regardless of whether or not there's a US estate tax liability, my executor has to file an estate tax return within 9 months of my death. There's an extension available, but the initial deadline is 9 months of date of death. I think, okay, my goodness, do I have an estate tax liability? The rule of thumb is that if my world estate is less than the exemption in place in the year of death, there will not be a US tax liability. Doesn't mean I don't have a filing requirement, as I just said, but as long as my world estate does not exceed the exemption in place for my year of death, then I will not have a tax liability. Current exemption, again, Donald Trump, Tax Cuts and Jobs Act created the most generous exemptions in history in terms of US estate tax. However, the definition of the world estate for estate tax purposes is much broader than what we understand from a Canadian tax perspective or a Canadian definition of what an estate is when we're thinking about probate. It also includes ownership of life insurance, for example. It includes property owned joint with right of survivorship. So getting to that number can be a lot easier than we might otherwise think. So it's important to just have a sense of what is involved in the calculation. So again, US transfer tax system, what does that mean? It's estate tax at death, it's gift tax during life, and it's also generation skipping transfer tax. We're not going to cover that today. It doesn't come up that often. US transfer tax system, it applies to our US persons on their world assets. So again, I'm a US citizen, I'm the dentist that's living in Toronto. US estate tax, gift tax is gonna apply on my world assets. If I'm me, I don't have US ties, other than I might have some US situs property, then I'm only concerned about the application of estate or gift tax in respect of US situs property. Whether or not you're a US person or not, the rates and the thresholds are the same. You're taxed on value, not on gain. So in Canada, we're used to having, we have a date of death tax. It's effectively a deemed disposition. It's capital gain. In the United States, the estate tax regime is a value. Same with gift. It's not capital gain, it's value. Graduated rates from 18 to 40%. I think the 40% kicks in at value over $1 million. Lifetime unified credit exemption, as I said on the last slide, 12.06 million for 2022. US persons, regardless of where they live, get the full exemption on all property gifted during life or at death. So say someone is a US person, they live in Toronto, they die in 2022, they're single. We're talking about a single person right now. Their exemption is 12.06 million US. Say they gifted $1 million of value during their life. The exemption left at the end of the day is only 11.06 million. So it works together. The exemption is tracked through your lifetime. For Canadians, again, Canadians who are not US persons, the Canada-US treaty offers a prorated exemption in respect of estate tax only. We don't get any benefit for gift tax, but in respect of estate tax, we get a prorated exemption based on the value of our US situs assets at death over the value of our world estate. So we get, again, a percentage of the exemption that we would if we were a US person based on what's the value of our US situs assets over the value of our world estate. It's important to note that the generous exemption that we experience now is going to continue to rise by rate of inflation until the end of 2025. So on January 1, 2026, by legislation, the exemption is going to revert back to pre-2018 rates. Inflation adjusted, we expect that to be about $7 million on January 1, 2026. So you're going to go from probably 14 million in 2025 to about 7 million in 2026. That's under current legislation. The Biden administration does want to see this exemption reduced further. $3 million, $2 million. These are the types of levels that generally a Democratic government wants to see in place. Whether or not he'll pass that legislation and be able to is another story, but certainly that is the mandate of the government in power at this time.
Okay,
We want to
Rebecca,
be aware.
Sorry,
Go ahead.
Can
No, you're
you
good.
just give us a concrete example in simple numbers? If you have if you buy your Arizona property and you die, what your exemption is? It's based, you said, on your on a percentage. There's a formula of the value of the property in the U.S. against your total net worth. Is that what I understood?
Yeah, so I should have a slide that gives an example. It's difficult to do that. It's exactly the proration. So if you are the 12, I'll try to explain this it'll take me a couple of steps. But the exemption of $12 million right now translates, and I'm just going to see if it's on the next slide. Oh, no, it's on this slide. The $12 million exemption translates into a tax saving of almost $4.8 million. The number's at the bottom of this slide, $4.8 million. So if I am a Canadian and say my estate is worth $12 million, my world estate is worth 12 million US dollars. And say
that world estate, if you have jointly owned property with your husband or someone else, it's half of that value, right? Half of the jointly owned.
It's not. It's the full value unless you can prove that you contributed 100% of the capital to it. You have to. So go ahead.
You mean your partner or your spouse contributed 100% of the value. So in other words, if you jointly own another property in Canada, you have to declare the full value of that other property as part of your worldwide estate.
Unless,
yeah.
So on the face, it will be fully included in the value of your world estate. Yeah. You have to prove that no, the joint owner, the other joint owner contributed half the capital.
Oh, half. Okay, fair enough.
Yeah. Or whatever the case is, like whatever their contribution is, whatever you're trying to say, no, that's not part of my estate. You have to prove that that other owner or number of owners contributed the capital to the purchase. Being a joint owner, I can be legally a joint owner of a property. It doesn't matter what I've contributed. The tax system looks at it differently. And so does the US, right? So yeah, so on the face, the IRS will say, no, well, you have to fully include that value in your world estate.
Okay.
You say, no, I don't, because my wife, for example, contributed half the value to the purchase price. If you could show that, then it's like, okay, then you only have to include half the value. So you have to go through some hoops. But just by way of example, with respect to what does the exemption look like? Onto the proration. So say we have $12 million of world estate value in US. We die in 2022. Say of our world estate, 1.2 million is tied up in US real estate, US stocks and bonds. Then the actual credit that you're going to get at the end of the day is 10%. So 1.2 million US situs, 12 million estate, world estate. 10% of my estate is US situs property. So I'm going to get 10% of that unified credit. For 2022, a $12 million exemption translates into 4.7 million of tax savings. I'm going to get 470,000 of that because as a Canadian, my US situs assets represent 10% of my estate value. That's the simplest that I can do sort of in conversation. And thank you. I'm going to take that as feedback to include a slide with an example.
Okay.
So generally, and again, if your world estate is less than the exemption available, you will not have a tax liability by the way that the formula operates. You just won't. The only way that you're going to have an estate tax liability on death, if you're a Canadian, is if you have US situs property in excess of $60,000 US and your world estate for 2022 exceeds 12.06 million. There's
That's
also
clear. That's clear.
Oh, okay, is that clear? Is that helpful?
That's clear, I think, for most people listening.
Yeah, that's actually really helpful. So if your worldwide estate is less than 12 million, right away, you don't need to worry about this, basically.
That's right. But
Yeah.
you still have to watch your US situs
Yeah.
asset levels, because once they go over 60, you've got to file that tax return.
Yeah, you just have to fill out a truckload of paperwork. So
That's right.
hire
people.
hire the professionals to help you do it, is what I'm getting
Yes.
from this entire presentation. Yes.
Yes, that's a great theme. I mean, that is the theme. But
Yeah.
but yes, do I have an estate tax liability that I have to worry about? Only once my world estate goes over that exemption. And that's why I think, you know, as individuals, as advisors, we need to be watching for these world asset levels, especially as we tip into 2026 and the exemption will be cut in half. There's no way that the government in power is going to allow that exemption to continue on or increase it. It's going to either be cut in half by existing legislation, or it will be cut further by new legislation, given the administration currently in place. So what are some takeaways, some things to consider? I think from, you know, from a client support perspective, it's really, okay, are you a US person? If you are, okay, what are your filing requirements from an income tax perspective? Get those. What are the information returns that I have to file from an income tax perspective on an annual basis? And then also from an estate tax perspective, what do I need to be thinking about annually? Number one, I'm watching the level of US situs assets. If they go over 60, I need to remember, or someone needs to know, if I pass away, an estate tax return has to be filed. If my world estate then goes over the exemption in place, I'm watching that exemption. If my world estate goes over, then I need to be thinking about, okay, I've got an estate tax liability. There's an ability to estimate what that is on an annual basis. If it's not that big, fine, maybe I can insure out of it. Generally, you could do that. You could also consider gifting assets during your life. That is a possibility. You can, but the minute you gift US situs assets, you get caught with gift tax. There are exemptions, not exemptions, exclusions in place from a gift tax perspective. So you can whittle down your US situs position on an annual basis by gifting within the annual exclusions. And then you think, okay, well, the prorated exemption under the treaty isn't enough. My wealth, my world estate is sufficiently large, and my asset position is sufficiently large that I'm going to have a significant estate tax liability. That's where you start to undertake trust planning. So certainly for most people, the exemption in place now takes it all away. But 10 years ago, that wasn't the case, and you saw more and more people engaging in trust planning. And I think that will come back in future years as the exemption levels start to wane. What is US situs property? I think this is just an excellent resource to get a sense of, okay, what goes in the top part of that formula? Obviously the real estate, the US securities, this is important, even if they're held in the Canadian brokerage account. My Google shares held in my Canadian brokerage account, US situs property, US mutual funds, US listed ETFs, US retirement plans. This is why some people that might otherwise not, so say I'm a Canadian and I am, you know, I'm not a US person, but I'm a Canadian, but I've got this US situs property. I'm scared or I'm worried or concerned about my estate tax exposure. That would be a reason to still consider transferring your 401k or your IRA into your RSP. Because once it's out of those plans, then it gets taken out of the pot of US situs property. So that would be something to consider. What's not US situs property? I can have cash in a US bank account as long as it's not used for business purposes. That would not be US situs property. Canadian bank cash, any positions held in my Canadian mutual funds, my ETFs, that type of thing. So I can hold my US investments inside of those Canadian funds, and it would not be considered US situs property. Same with Canadian corporation shares. So one thing from a perspective of a state tax mitigation. A planning consideration could be to hold your US situs property inside of a Canadian corporation. That works really well when you're thinking about, Google shares, for example, pure investment property. That can work really well, or a piece of real estate in the US that is purely for investment purposes. But once you start again to live in that or use that piece of real estate as a vacation property, then you're going to fall offside what we call the shareholder benefit rules in Canada. And that's where Canadian corporations can be problematic. But if you're dealing with it purely from an investment property perspective, putting your US situs property inside of a Canadian corporation could be helpful from an estate tax perspective. And then what's in the world estate? Of course, it's the fair market value of anything owned directly at death. And then here's the kicker, I think the points to highlight. 100% of the value of the property you own, joint with right of survivorship, unless you can prove the other joint tenant contributed capital to the purchase. And then value of death benefit of life insurance policies. So life insurance policy death benefits where the deceased was either the insured, and then there was these incidences of policy ownership. So if you could change the beneficiary, if you could borrow against it, access the cash value, all those types of things, then you're going to have to include the value of that death benefit in the value of your world estate for US estate tax purposes. And then in closing, just a reminder, so gift tax, what are the exclusions essentially? If I'm a US person, gift tax is going to apply to anything I gift, regardless of where the property is located. If I'm a non-US person, then gift tax applies only to transfers of US situs property. Now, the definition of US situs property for estate tax is slightly different than for gift tax, and I have included it here. And the takeaway here is, what can I do then if I'm a US, if I have US situs property, how can I move it around without falling into the gift tax trap, so to speak? If you have two US citizen spouses, you can move property around all day long, and that's fine. Gift to a non-citizen spouse, $164,000. So you can gift US property to a spouse in 2022 up to $164,000 a year, and you don't have any gift tax issues. You can also gift to non-spouses. So if I have 4 children, for example, I could gift up to $16,000 of US situs property to them annually. That's the 2022 exclusion, and I wouldn't have any concerns. So that's another thing to be thinking about, is what's my estate tax exemption and what are the gift tax exclusions if I want to use lifetime gifting as a way to manage the value of my estate.
So if a lot of the questions that'll come out of this are going to be complex, and so ideally we're going to pass them through, Jeff, Eric, or myself, and we'll bring them to the CI tax, the TREP team, and get the questions answered. What we've learned from this is a lot of complexity in it, and we do need to engage professionals to help us with cross-border taxation, and that's one of the key things. And so that's where obviously our team can help with that, or getting a professional to help. I know Jeff had a question.
Not a question, just a comment. It's unreasonably complicated. If you're a US citizen, if you're a Canadian citizen, I think you can puzzle through this, but just this whole joint ownership proof, I was just thinking, classic example, you buy a property in the US, you have a line of credit that's joint, and you use that for your down payment. Will that be sufficient to prove that it's joint contribution, or like who funded the, really?
I think, well, I can think about just property, that line of credit is associated with a piece of property, right? If there was 2 people that contributed to the purchase price of that property, then I think that should be sufficient, but it would have to go back to that. Who was the person that facilitated the capital that allowed for that asset to facilitate the line? And I think that's
okay. Just real quick you know, and this is most cases, I'm sort of being generic, but most of our clients would have a principal residence, have an equity line of credit set up on that principal residence. That would all be jointly owned. If you had to go back and determine who originally purchased with what funds that principal residence, like you have to show proof of check. I mean, it just seems ridiculous. But you know, I don't know how detailed this has to be, but that seems to be in most cases how people would structure a purchase of U.S. you know, vacation property as an example. You know.
Yeah, you know, that's happening years ago, and it's young in a relationship. There's probably some argument that, you know, it is jointly contributed to, or you might do that by affidavit. You know, there's going to be some reasonableness applied, but it's our job to communicate the rules, right. And all of our jobs to know them, and I think that's the starting point.
Yeah, no, fair enough. It's it takes the bite out of ownership.
It's mind-numbingly complex.
Yeah,
mind-numbingly complex, and we're seeing governments around the world. I mean, I can point to our own Canadian trust disclosure rules now to go, what on earth are you
thinking?
what on earth are you trying to accomplish? It does seem unreasonable. However, these are the times in which we live.
We live, correct. Anyway, thank you. That was brilliantly in very complex cases.
There's a few other questions that are on here. They're all fairly complex, and in the time that we have from, and the answer really is it depends for most of them. So what we could do is we can reach out to you guys on the questions that you have. We work for CI Asante Wealth Management and the WWH Financial Group as advisors, and Rebecca and her team are one of the wonderful resources that we have available to us. So Yoga, to answer your question, if you want to reach out to us and help us and look for help with your cross-border tax and financial planning, we are here to help you, and we would love to have a chat with you and see you know, where we can help, and the same goes for everybody else as well. So I think we're going to, I know we've taken about a good chunk of everybody's time, and I appreciate everybody staying with us this long. And you know, we look forward to seeing you all on the next call.